Hi, good afternoon. It's Rick Schwartz. Thank you for joining me today as we'll be talking about some year-end and actually throughout the year tax saving strategies and plans that you can take advantage of, assuming the circumstances fit for your specific tax situation. With just another couple weeks before the end of the year, there are a few things you can still do before the end of the year that you may be able to take advantage of as we talk through all these today. So let's get started. First of all, I just wanted to bring up the fact that with regards to the Tax Act going back to the end of 2017, which took effect in tax year 2018, the biggest issue was the limitation on your itemized deductions, which most people had the most room to play with in order to save taxes by playing with these different types of deductions before the end of the year. With the new tax law, your deduction for state and local income tax, which was the biggest issue for most of our clients, now being limited to $10,000. Prior, it was unlimited. Any new debt that you took out on your house is now limited to $750,000. In the past, that was as high as $1.1 million. And what's now gone are the 2% miscellaneous itemized deductions, which included any unreimbursed employee business expenses that you may have had through work, anything that you spent out of pocket related to your job that you didn't get reimbursed for from your employer, tax prep fees for a regular taxpayer. Typically, if you own your own business, you can deduct those expenses through your business. But for the majority of taxpayers that don't own their own business, that no longer is deductible. Same with investment advisor fees. For some people, they were substantial. Again, no longer deductible beginning with the 2018 tax year. So there are other ways that you need to get involved, creative, things to think about going forward to help you take deductions beginning in 2018 and going forward over the next several years. One of the items that isn't changed is charity, still deductible. A lot of our clients thought it was not deductible going forward. It is relatively unchanged. The issue became with the higher standard deduction that so many people, if you didn't have a mortgage and you weren't making a large charitable deduction, then your charity, in a sense, became non-deductible because you'd be using the standard deduction on your tax return. But it is still a deduction. The only real change to it is in the past, you were only allowed to claim up to 50% of your income as a charitable deduction, which is high to begin with, meaning if your income was $200,000, you could claim up to $100,000 of charity in a year as a deductible item. Very few people deduct that amount of charity. That now is increased to 60% of your adjusted gross income. So there is a strategy of bunching with regards to such deductions, and medical works in a similar way because that is uncapped as well, where if you don't have enough total itemized deductions to itemize your return and you do the standard deduction, what you want to do is, if possible, bunch them every other or every third year. For instance, maybe donate 3 years of charity in 1 year and don't donate in the next 2 years, and that will allow you to at least get above that standard deduction in year 1, and you'll do this the standard deduction in years 2 and 3. And I'm going to talk a little bit more about that in a few minutes when we talk about donor advised funds. Another way to, or just to be aware of with regards to making charitable contributions, if you do hold appreciated stock, you probably do want to think about donating the appreciated stock instead of just donating cash. And I'm going to walk through an example of why this may be working out to your benefit to making this type of a donation. First of all, you just want to be aware that this applies only to long-term appreciated stock. So anything held for 1 year or longer, if it's less than 1 year, you're not going to be able to do this strategy with regards to charitable giving. The donation deduction you're going to be allowed when you donate donate a stock or a mutual fund to a charity, is that donation goes over at the fair market value of the stock on the date of the gift. So if you have shares of Apple that maybe you bought several years ago for, let's say, $1,000, and now that stock is worth $6,000, your donation is at the value of $6,000. So it's a pretty substantial deduction, especially I know I see it with clients often that they've been gifted stock by their parents or grandparents going back 20 or 30 or 40 years. It's really appreciated significantly over time. They can donate that stock and it goes over as a deduction at the fair market value as of the date of the gift. By doing that, you avoid any capital gains taxes. There's also a net investment income tax of 3.8%. You avoid that as well by donating the fair market value of the stock. Let's walk through an example of why you might want to do this. So scenario number one is you sell the shares of stock and then you donate the cash that's left over. So in this situation, this taxpayer bought stock several years ago at a value of $2,000. It's done extremely well over the past couple of years. It's now worth $12,000. So he goes out in the market, sells the stock, capital gain of $10,000. Okay. Federal tax rate is 15%, so it's $1,500 of taxes. Net investment income tax is going to be $380. Mass tax, Massachusetts state tax is $500 in this situation. What's left over after taxes is $9,620. You donate that on your tax return or you donate that to a charity. Person's in a 35% tax bracket, so the tax savings is $3,367 in this scenario. Taxes due from the sale, remember we have the state income taxes, the investment income tax, and federal income taxes. Those all total up to $2,380. So you do realize a tax benefit of $987 by going out into the market, selling the stock, and then donating the cash that's left over. Okay, scenario number two is just directly donate the appreciated stock to a charitable organization. Again, same facts. You have stock that you bought for $2,000 more than a year ago. Current fair market value is at $12,000. Long-term appreciation is $10,000. So in this situation, it really doesn't matter with regards to taxes at appreciation. Okay, you're in a 35% marginal tax bracket. So again, you're donating the appreciated stock, so there's no sale. Federal taxes are zero, net investment income tax is zero, mass income tax is zero. Okay, in this situation, you have $12,000 left to donate because you didn't pay any taxes, or essentially the stock goes over to the charitable organization at $12,000. 35% tax bracket leaves you with a $4,200 tax benefit. Again, taxes due from the sale is none. You didn't sell the stock. The net tax benefit is $4,200. If you're going to compare that to the first scenario where you're going to sell the stock and then donate the cash that's left over after factoring in the capital gains, that's $4,200 versus $987. So if you are in a situation where you hold appreciated stock, you do want to consider that as a charitable donation. And then if you want to hold this stock, you actually can go back out onto the market, buy it again for the $12,000 that you would have donated otherwise. And now the cost basis of this stock is $12,000. You've just avoided having to pay capital gains tax on this. So it's certainly a worthwhile strategy for donating if you're holding long-term appreciated stock in your portfolio, as opposed to just donating cash. In most of the financial charitable organizations, they'll gladly accept it. You'll need to get a letter back from them. They easily provide that. They will list the fair market value and the date of the donation on that letter, and you just need to keep it for your records, show it to your tax preparer at year end, and that's what you're going to claim for a deduction. Okay, I do want to focus next on donor advised funds, which I quickly mentioned about a minute ago. The main reason you may want to consider this is if you in the past have itemized your deductions. With the new rules, the standard deduction has doubled. The limitation on the state and local income taxes being $10,000, and maybe you have no mortgage. So with the new rules, you may not get above, if you're married, $24,000 as a standard deduction. So your charitable contributions, if they're going to be less than a certain amount, won't even be a tax benefit. But you can get around that by perhaps setting up a donor advised fund. Quickly, as it's defined, a donor advised fund is a charitable giving vehicle administered by a public charity created to manage charitable donations on behalf of organizations, families, and individuals. To participate in a donor advised fund, a donating individual or organization opens an account in the fund and deposits cash, securities, or other financial instruments. They surrender ownership of anything they put in the fund, but retain advisory privileges over how their account is invested and how it distributes money to charity. So Fidelity has these, Schwab has these, a number of other investment families have these. Essentially, you're going to contribute money into the donor advised fund. You could do as much as you like. You're not limited in what you can put in. The money sits in the fund. You take the charitable deduction in the year you contribute the money into this fund, and then you distribute it out over a period of time, okay? So again, you take a current year charity deduction for the full amount that goes into the donor advised fund, and it's held within that fund, and hopefully it's going to increase in value over time. Over the next several years, as you determine, you're going to pay out of this fund to the different charitable organizations that you want to donate to, whether it be your school, a hospital fund, any type of your religious institution. The money comes out, but it's not deductible as a charitable deduction in the year it comes out because you took the full year deduction in the year that you've donated, put the money into the charitable fund itself, into the donor advised fund. Okay, so let's walk through an example with this too, just to help you visualize exactly how this will benefit you. So in this scenario, you have a married couple, combined wages are $400,000. They have investment income of $15,000. State and local income tax deduction is capped at $10,000, even though the total amount is $35,000. They don't have a mortgage on their house anymore. Typically, their charitable deduction is $13,500, okay? So if they do not fund a charitable donor advised fund and they donate $13,500 per year in the 3-year period, 2019, 2018, 2019, 2020, they will end up using a standard deduction on their tax return of $24,000 each of the 3 years, okay? The reason they're going to do that is if you look, they're capped to $10,000 for state and local income taxes each year. You're going to claim a $13,500 charitable deduction each year. Their total itemized deductions are $23,500. The issue is they get a standard deduction of $24,000, so they're really deriving no tax benefit from that charitable contribution done each of these 3 years. Okay, so in this scenario, they'll do a standard deduction each year and end up with, over the 3-year period, total taxes of $258,000, federal income taxes. Scenario number 2 is, well, let's set up a donor advised fund. In year 1, they'll donate 3 years of gifts into this donor advised fund. Okay, so the 3 years is $40,500. They don't make any charitable contributions into the donor advised fund in year 2019 and 2020 because it was all done in year 1. All right, so in this situation, they front loaded their charity into 1 year. Okay, so year 1, they have a $40,000 charitable donation. In year 2, they have no charitable donation. In year 3, they have no charitable donation. So in year 1, they're actually going to itemize their tax return. They have total itemized deductions of $50,500. They'll do the standard deduction in the following 2 years. They have no charitable deduction. Okay, so based upon these facts, their total tax over the 3-year period of time is $249,500. So by doing this and grouping your charity deduction into the first year, or into one of the 3 years, you actually end up benefiting tax-wise by $8,500. So again, you have to have the funds available to do this and make that large contribution in 1 year. But if it's something you can do, and if it's moving money from your portfolio where you'd be giving it over the next 2 years anyways, it's something to consider. It's a very, the tax benefit could be quite large. Okay, just to summarize, the tax benefit with the donor advised fund, $249,000, or the taxes are $249,500 versus $258. So setting up the donor advised fund actually saved the taxpayer $8,500. And again, we were talking about donating appreciated stock. You can contribute appreciated stock to the donor advised fund, and again, avoiding capital gains tax at the same time. So there's quite a bit of strategizing with regards to charity on your tax return if you're not going to itemize your tax return otherwise. Another way you can benefit with regards to charitable distributions or charitable deductions, again, if you're a little bit older, you're in a position where you are starting to draw on your retirement accounts, you probably don't have a mortgage at this point, you may not be donating that much to charity because you're on a limited budget. What you can do is take a qualified charitable distribution. So it's an otherwise taxable distribution from an IRA owned by an individual who's age 70 and a half or over that's paid directly from the IRA to the qualified charity. So instead of taking the deduction, the distribution out of your retirement plan, putting it into your bank, and then writing a check out of your bank to the charitable organization, you can have the distribution go directly to the charitable fund itself. So instead of increasing your income by $10,000 for your distribution out of the retirement plan and then taking that $10,000 and sending it to the charitable foundation, you may not itemize in that situation. So this way, you're actually lowering your income by having the distribution go directly to the charitable organization. And this can be up to $100,000 of distributions per year per individual, and it actually satisfies your annual required minimum distribution if you're age 70 and a half that you need to take. Okay, I just want to change the focus a little bit and talk about capital gain issues for a few minutes. New in 2018, there's a way to defer your capital gain by making an investment into a qualified opportunity zone fund. Okay, so per the IRS, a qualified opportunity zone, it's an economically distressed community where new investments under certain conditions may be eligible for preferential tax treatment. Localities qualify as opportunity zones if they have been nominated for that designation by the state, and that nomination has been certified by the Secretary of the U.S. Treasury via his delegation authority to the IRS. Okay, so they've been around, but they do need approval. They are in every state, these qualified opportunity zones. And with regards to investing, again, there's a way to defer the gain by investing into these funds. So Qualified Opportunity Fund Zone is an investment vehicle that files either a partnership or corp, federal income tax return organized for the purpose of investing in qualified opportunity zone properties. Okay, so what that means with regards to your tax strategies, with the new tax law that came about, you can invest up to your full amount of capital gain from the sale of an investment, as long as you make that decision and invest it within 180 days of selling the underlying security and invest it into the fund, you can defer the capital gain on that investment. Okay, and you can defer that gain up to the date that you actually decide to recognize that gain, or the end of 2026. Okay, and gain recognizes the lesser of the deferred gain originally from that sale, or the qualified opportunity fund fair market value, less stepped up basis. And I'm going to talk about stepped up basis in a minute or so. So you can have a significant gain from the sale of an investment that you own, decide you don't want to pay the taxes on it now. You may have something happening in the future that may offset that gain that you don't have currently the accessibility to take advantage of now, and decide to recognize that gain in a later year, and it could be offset by a loss in a later year. Okay, the benefit is you can't carry a loss back into a previous year, so that's why you may want to defer it into the future. If your investment in the Qualified Opportunity Fund is held for 5 years, you get a stepped up basis of 10%. If you hold it the full 7 years, it can be stepped up an additional 5%. In order to take advantage of the full 7-year period of time, that investment must occur by December 31st, 2019. So you actually only have another 2 weeks if nothing has happened for you yet where you want to defer a gain. If the gain is invested for at least 10 years, there's no additional capital gain on the sale of the Qualified Opportunity Fund, separate from the gain recognized as of December 31st, 2026. So again, a bit confusing, but let's walk through an example, and it may make a bit more sense. And then we can talk about a specific situations where you may want to take advantage of this. So scenario number, or the only scenario for this, so you buy some stock, long-term capital gains, you decide to sell it on January 15th of 2019. Resulting gain is $100,000 of this stock. Okay. March 15th, you take this gain and you invest it into a Qualified Opportunity Fund. So remember, you have to invest this within 180 days of the original sale date. On March 15, 2024, the date you're invested in, the basis actually increases by 10%. So your basis currently is 0 on this capital gain. Well, now it's 10% of that $100,000. So you've just increased it by $10,000. Holding it another 2 years after that 5-year period, you get another step up of $5,000. Okay. Hold this stock. Let's assume the fair market value of the fund exceeds the $100,000 gain initially deferred. Okay, so you have to recognize a gain on that date because you're still holding this into the qualified fund. So your gain recognized now is only $85,000 because you're allowed to take advantage of the stepped up basis of $15,000 as noted above in this example. Okay, then let's say you continue to hold the fund. You think it's going to be a good investment over time. You sell this fund after March 16th, 2029, because it's now been held 10 years. Let's say the Qualified Opportunity Fund fair market value is $200,000. You'll actually recognize no additional capital gain on this because you've held this investment for more than 10 years. So you recognize the $85,000 gain at the end of the 2026 period that you need to recognize this gain, but no additional gain needs to be recognized on this investment. When you might do this, again, if you have a sale of a stock that you've held for a long time, you're going to pay significant capital gains on it if you recognize it on your 2019 tax return. But let's say you have who knows, a rental property or some unique situation where you're going to sell something for a significant loss in the next year or two. You want to take advantage of that loss, you defer the gain into the future. Okay. Another situation, maybe you're selling your practice. Maybe you're a practice owner or a business owner, significant capital gain, not sure if you may have something going on in the future. Maybe you think the market is going to turn around and take a dip in the next year or two. That way you could take advantage of losses against this gain in the future and not have to pay the taxes on it today. And you'll pay reduced taxes on it in the future if you're going to have a loss to net against this gain. Again, and then you'd recognize it in that future date. I still want to stay a little bit with capital gains and loss, talk about managing your capital gains and losses a little bit. Again, capital losses will offset capital gains on your tax return. So first, what you want to do is determine your net capital gains or loss that you have on your tax return. Total capital gains less total capital losses are what your net gain or loss is. If you are in a loss position after you subtract your losses from your gains, if your losses exceed your gains, you can claim an additional $3,000 or up to $3,000 of losses against other income on your tax return. Any amount that exceeds $3,000 in that tax year will be carried over into the next year to be utilized then. Okay, so you want to see what you have. If your losses exceed your gains, they will offset up to $3,000 or up to $3,000 of those losses will offset other income such as wages, dividend income, private practice income. Then the amount in excess of $3,000 carries over into the next year. Okay, so first you want to determine your current year losses plus any prior year capital losses on your tax return. Take a look at your portfolio of investments, see if there's anything else with net losses, determine if they are items you want to sell or if you think they're going to come back. So maybe it's a good time to sell your losers. Again, it's a discussion with your portfolio advisor, or if you do it on your own, to take a good look at this and give some thought to where you want to be. Figure out what you have for winners, and if you're in a loss position before you're looking at your winners, you probably want to sell some of your winners. They will be offset by the losses, and ideally you'll pay no taxes on these. And if they are stocks, the winners that you really wanted to hold on to long term, well, you can go out and buy them again, and now you've just stepped up your basis. So when you sell them down the road, any capital gain is going to be lessened by that now increased basis you have in the stock that you've repurchased out there. Tax credits. Okay, there's another area that you can take advantage of from tax planning. Okay, there are three big ones out there: solar, automobiles, and children. Okay, so let's start with talking about the solar tax credit. We've seen it a lot over the past couple of years where taxpayers are putting solar panels onto their roof, and there is a significant tax credit for that. It's based upon a set percentage of the installation cost of a solar system in your house or on your house. You are allowed to take that tax credit in the year the job is completed. Okay, so it has to be finished before you can claim that credit on your tax return. There is no limitation on the costs of the project of the solar panels. So if it's $5,000, if it's $10,000, if it's $40,000, it is unlimited. Installation costs include the cost of materials, the cost of labor, and a question that comes up often is, I'm doing roof work at the same time, can I claim that as part of the credit? And typically, what I've researched and found, if the roof work required is structural with regards to having the solar panels be better positioned on the roof without there being a roof issue, I would say it is a deductible item. If you're going to retile the roof because you may not be able to retile it later, that would not be an item that's related to the installation costs in the project. Some other items to consider too that may not actually show up on your bill from the contractor: if you have to do surveying and engineering costs regard to the project, they will typically be items that qualify for the installation costs and where you can take the tax credit. And I've even had a situation where there was tree removal required. Otherwise, the sunlight was not going to hit their roof, and that did qualify for the installation costs as part of the credit. Okay, so one thing to be aware of is after this tax year, 2019, the credit is going to start to decrease. So currently it's a 30% credit on the installation cost. So if you spend $30,000 to put panels on your roof that are solar panels, you're allowed a credit of 30% of that on your tax return. So that's going to be a $9,000 tax credit. And that's a one-for-one reduction of your tax versus a 30% deduction, which is a reduction of your taxable income, and then you figure the tax credit on that. So a tax credit is a bigger bang for the buck than a deduction. What you need to be aware of is after 2020, that tax credit for residential houses dips to 26%. 2021, it becomes 22%. And in tax year 2022 and going forward, you no longer qualify for that tax credit. So you need to be cognizant of the fact that this is going away unless it is extended, but as of right now, there's no legislation that I'm aware of that this tax credit is going to be extended for individuals. Okay. There was a notice that recently came out, I believe in 2018, that did talk about if the project is started by such and such a date, and if so much of the work is completed or costs are incurred by such and such a date, you may actually qualify for the 30% credit, even though the work isn't completed till after 2019. So it's something you need to bring up with your tax preparer when you're doing this, if you're going to be considering solar installation when the project begins, because you may actually qualify for the 30% credit if work was started this year. Okay. In Massachusetts, there is an additional $1,000 tax credit that is allowed on the mass tax return when you qualify for the federal credits. Plug-in an electric vehicle tax credit. Again, it's a credit, one-for-one reduction of your tax on the tax return, and it's related to the purchase of an electric vehicle. Based upon the battery capacity of the auto, there is a credit that phases out once the once 200,000 vehicles are sold by a specific manufacturer. So I know Tesla has already hit that, and actually GM as well. We'll talk about that in a minute. You claim the credit in the year the automobile is actually received and placed into service. So I know there's a time lag on some of these auto purchases. So you don't get the credit on the pre-order date. You get the credit when you receive. So if you have two issues. One, if you purchase the vehicle in December, but you don't take delivery until January of the next year, that credit will be taken in the next year's tax return, not on your 2019 tax return. And you need to be aware if it's in the limitation phase, because if they've hit 200,000 sales, again, it's the quarter that you actually receive the vehicle. Okay, so I'm going to talk about that a little bit in a second. So again, the tax credit phase out once a manufacturer sells 200,000 electric vehicles. So you get 100%. You get the full tax credit in the year of receipt, assuming you're under $200,000, or it's the first quarter after 200,000 vehicles, or the first quarter after sales have reached 200,000 vehicles. In the next two quarters, so that would be the second and third quarter after that limitation is hit, you're only going to get 50% of that original credit offered on the vehicle. In the fourth and fifth quarters after that $200,000 sale has been hit, you're going to get 25% of that tax credit. And once you've reached the fifth quarter, after the fifth quarter, that credit is fully used up. You won't qualify anymore. Okay? Tax credit was as high as $7,500 for a number of vehicles. As I previously mentioned, Tesla is pretty much done at this point. So unless you've received delivery by December 31st, 2020, you're not going to qualify for that credit any longer. GM is currently in the phase-out period. It's fully phased out for any vehicles purchased after March 31st of this. I thought it was 21, but maybe it's 2020. Okay, so that's fully gone. Tax credit, and actually I can look at that for you in a second, because I thought it was coming up, but again, maybe it was 2020. There is a link to see what's available for credits, and it's on the IRS website. 1 second. So if we look at, for instance, BMW, it gives you the car that's purchased and the credit available, and it has to be the original purchase of these cars, and a lot of them, they're not, or all of BMW is not phased out yet, but again, I'm not sure you can buy a brand new 2014 i3, so just to be aware. Let's see, GM, that was the one. It's the phase out has initiated. Let's see what it says. Yeah, I guess it's fully phased out at this point as of 3/31/2000. So just be aware that that some of these vehicles are in the phase out period already. If you're in Massachusetts, there is a rebate program as well, and that is expiring as of September 30th, 2019. Okay, so just be aware. Anything purchased after September 30th, you're not going to qualify for that credit. You need to make the application for this mass tax credit within 3 months of the purchase. So really, it's after December 31st, this credit is gone in Massachusetts. So if you have purchased a car and it was in the last half of September, you still have another 2 weeks to apply for this tax credit. The link is below. If you need these links, you can email me after the session today, and I can forward you them. so you can work on it. And this rebate program is not an item that gets picked up on your tax return. It's done through this organization, whereas the tax credit for the federal tax return is picked up right in your tax return. You need to report the name of the auto, the make of the auto, the date of purchase, and that you put it into service, in the automobile VIN. Okay, the third credit I just want to briefly touch upon is child tax credit. And you qualify for tax credit if you're married, filing jointly, and your income is below $400,000, or single or head of household if your income is below $200,000. It is phased out, so it's not an all or nothing type thing, but it phases out once you hit those income limitations. If your child is under age 17, it's an automatic $2,000 tax credit. Other dependents, it's a $500 tax credit. Previously, before the tax law change in 2018, that credit was $1,000, and it was phased out once your income was above, I believe it was $100,000. So nearly very few of our clients actually qualify for this credit, where now quite a few qualify. It was a big step up that we saw with clients this year. The reason I bring it up, you may not have much control over your income, but if you are going to receive a bonus and it's near year end, and you are near either the $400,000 or $200,000 threshold, you may want to talk to your employer to see if you can push it into the next year, as it will impact the credit for the children on your tax return. Okay, I do want to talk about Lightkind Exchanges a little bit. We do have quite a few taxpayers in our office that own rental properties. A Lightkind Exchange allows you to sell a rental property and defer the gain on the sale of this. So if you bought a property, and it's not uncommon that I see taxpayers that maybe owned a house in the downtown area, or a condo, got married, had kids, moved out of the city, but kept the property as a rental property, figuring it's going to pay for itself with the rents that are generated. They may move back into it later on in their life. They may sell it later on, but for now it's a rental property. Well, if you decide to sell this and you invest in a similar rental property within a specific period of time, you can actually defer the capital gain on the sale of this rental property. Okay, and the only real issue with regards to the tax rule changes in 2017 is prior to the tax rule change, you could actually do these like-kind exchanges with equipment, with vehicles, with personal property items, which really focus more on businesses than rental properties. Going forward, only real estate will qualify for this like-kind exchange. Okay, so let's talk about this for a second. With regards to a like-kind exchange, you cannot accept the cash from the sale of this property, and you don't pay for the new property. Okay, so it has to be done through what's called a qualified intermediary. And this is an independent third party that helps with this transaction. They hold the sale proceeds for when you sell the original property, and then when you buy the replacement property, they actually buy the property for you. So the money never goes through your bank account. It always needs to go through the qualified intermediary. If you are going to do this on your own, you will disqualify the transaction, and you won't qualify for the deferred tax gain treatment on this. Okay, there is a strict timeline. The start date is the date you sell the property. You need to identify a replacement property within 45 days from the date of the sale. You need to finalize the purchase of the replacement property within 180 days of the sale. Okay, so you need to meet those strict dates in order to meet the rules for a 1031 like-kind exchange. You can't walk away with any cash at the end of the day. Okay, so really what you need to do is, when you do the like-kind exchange, the property that you buy needs to either equal or exceed the value of the property that you're selling, okay? Or else you're going to walk away with either an amount of cash or reduced debt at the end of the two transactions. And either of those are called boot. And if you have any boot at the end of the day, you are going to pay taxes on that up to the capital gain on the property. So you got to be careful that when you're doing this, that you're actually having no cash left over that you're going to receive at the end of the two transactions, the sale and the replacement purchase. Again, as we noted, transactions must only involve business and investment properties. You can't do this with the sale of your residence. You can only do it if it's a rental property that you own, okay, business generating property. And why would you do this? One, obviously tax deferral if you want to sell the property and defer taxes. But again, you have to reinvest it into another property at the same time. So that brings up the question of diversification. Maybe you want to get investment property in another area of the United States. You don't feel the property where it's in now is going to really go up in value beyond where it's gone up over the past couple of years. Maybe capped for one reason or another economically, that the area may not be as forecasted to do as well going forward in the next couple of years. You may want to diversify from residential into commercial property, rental properties. Maybe you have a single family, can invest into a multi-family rental property, or you can even invest from a single property into 2 or 3 rental properties going forward. So it gives you a bit of diversification from just holding the one property you've held for a number of years. Leverage as well. You could reinvest into a higher priced property that has a potential for more investment returns over time. So there are a few reasons why you may want to do this and sell the property you have on, even though you may be closely tied into it. There are ways to increase cash flow over the future and not have to recognize a capital gain by doing this. There are ways where you may be actually, I said a second ago, if you receive cash at the end of the day, you are going to have a taxable gain up to the value of the cash that you receive. If the real estate activity, if you walk away with cash, things to consider is, have you had passive losses on this activity in the past? Passive losses will offset passive income, and boot received is considered passive income. So if you're showing losses, which most properties do, unless there's no mortgage on them, you actually can walk away with a little bit of cash, and it can be offset with your passive losses that you've had on this property or that you've had on other properties that you own. So you can essentially cash out, pay no taxes on the capital gain, but it will affect your carry forward losses in the future because you've used up some of them. So again, it's one strategy of cashing out with regards to the real estate property and really not having to pay taxes on it in the current year. If you're thinking of starting a business, there is new, beginning with the tax law, qualified business income deduction. It's a 20% deduction created under this new rule. Schedule C taxpayers, sole proprietors qualify. If you have rental income, it qualifies. Partnership and SCorp income qualify as well. But it gives you, you're going to want to think about how you should form this new entity. Say you're forming your own private practice, SCorp or single member LLC. And there are benefits to becoming a single member LLC if you're starting this up and you're 100% owner. Okay, the issue is with an SCorp, you need to take reasonable compensation. So that, in effect, drops what your net income is with regard to this entity. And this qualified business deduction is based upon the net income of the entity. With a sole proprietorship, you're going to have a higher qualified business income, QBI, because you're not taking any salary out. Sole proprietors do not take salary. So it's a bit more involved, and there are income limitations involved with this whole thing. But to walk through a quick example is scenario number 1, you're a Schedule C taxpayer. Your total net income from the Schedule C is $350,000. Scenario number 2, you have the same $350,000 income from this corporation, but part of it is wages, $250,000, and then you have $100,000 of SCorp income. So you're at the same place, $350,000 in each situation. With regards to the pass-through deduction with the Schedule C owner, it ends up being a $65,000 deduction. The SCorp owner, because it's based upon the $100,000 number, that deduction is only $17,800. So the federal income tax is going to be lower in this scenario with the Schedule C owner by about $14,000. So before you set up any new business, you are going to want to think about where you qualify for this, or if you're going to qualify for this deduction or not. So it's a conversation you really should have with your tax preparer prior to forming this this new endeavor going forward, if that's the direction you may be going into. Finally, I just want to finish up with a couple of last items with regards to self-employed individuals and where they can benefit by hiring people or hiring your own family members into the company. Let's start off if you're hiring your spouse. Maybe you have a non-working spouse or part-time. Again, if you hire your spouse, there are certain benefits. First, maybe they never worked once you got married and had kids. With regards to Social Security benefits, you need to work 40 quarters to qualify. So if they're short the 40 quarters, which essentially is 10 years, by employing them, they are going to meet that 40-quarter rule if you can hire them long enough or have them on your payroll long enough. Retirement planning, again, if they are working for your company and you're paying them W-2 wages like other employees of your company, they can be part of your pension plan. So added tax deferral money and just additional retirement planning that you can do by hiring your spouse, it can just add up over the long term. Typically, or oftentimes, spouses do accompany the business owner to meetings. Well, if they're part of your company, they're an employee, and you can create the bona fide business purpose appearance of them traveling with you, their travel expenses now become a deductible business expense, where they are not a deductible business expense if they're just accompanying you as your husband or wife. Okay, so just be aware of that. And if you're self-employed and sole proprietor and your spouse is working for you, get them set up and have the health insurance premiums be part of their benefit as opposed to the business owner's benefit. You will save in self-employment tax deductions. So just be aware there are benefits of hiring your spouse. If, again, typically we see it when it's a non-working spouse, and they usually do have a role, part of the management of the practice so far, for instance. And finally, I just want to talk about quickly, it's similar to hiring a spouse. If you have children that are maybe teenage children, a little bit older, that you actually can have them do some work for your company, pay them. You do want to pay them when you're paying everyone else. You don't want to write one big check at the end of the year and say, here's your paycheck for the year. They do need to be on payroll ratably throughout the year. With the standard deduction being $12,200 in 2019, essentially you can shift $12,200 towards them through wages. They won't pay taxes on it, and you get the deduction on your tax return for it. So you've just reduced your income by $12,200. They can use that money to put into a Roth IRA. They can contribute up to $6,000 in 2019 into a Roth. Again, all they need to have is earned income, or they can contribute up to $6,000 or their earned income if you're paying them less than $6,000. Going to grow tax-free over their lifetime. Their wages can be used to pay for education costs. So again, it's a way to take a deduction and pay for tuition at the same time. And if you are self-employed, a Schedule C sole proprietor, if they are under the age of 17, they don't pay any Social Security or Medicare taxes on their wage income. So it can end up being a large tax saving by having your kids on doing work for your company. Again, if you're ever audited by the IRS, you need to show that they're actually doing work. You need to maintain records, but there are ways. I mean, the IRS is not sitting in your office throughout the year seeing what your kids are doing. You just need to create the appearance that they're doing work. I mean, and I would have them do some type of work for your company so they understand the value of the work that they're doing with regards to your business. But they can do some advertising. They may be able to do some website work. They may be able to do some billing, emailing your customers, patients, whatever type of business you're in, to help with collections and so forth. So there are certainly things that your kids can do, and it's certainly worth paying them and taking the deduction and shifting income onto your kids throughout the year. So those are the key points I really wanted to talk about today. I appreciate your time. If you have any questions, I am around. You can give me a call in the office, 781-938-0045, and pursue any of these in a bit more detail. I covered a lot, covered it quickly, but and not everything is certainly going to apply to everyone here, but there are certainly things that may spark your interest, and happy to answer those questions. So again, thank you very much for your time, and look forward to seeing people this winter, just a month or two away. Thank you.